All right, good evening, guys. Ken at Tortoise Capital Nightly Strategy Podcast for March 17th, 2023. We'll start with the swing portfolio. So earlier in the week and then last week, you saw that we had really good fortune with the continuation patterns that we decided to hold overnight. That was not the case uh, between yesterday and today. In almost every case, we saw sharp early reversals, and a lot of the extra buffer that we had from good afternoon moves disappeared either in a gap down or in an immediate sell off. So we're going to see that theme a lot. So that will happen. So this we'll start with Alcoa, and again, these are all on 30-minute charts. So this is Alcoa. We had the SSC PSAR flip, and it closed well yesterday, and then today gapped down immediately and started selling off. Hit the PSARs for a scratch, sold off, and held support here. Now it's still slightly above the previous RL10 excursion, so we do have the makings of a potential COTA 2 going into next week. So we'll see that a lot in the metals, but basically erase the gains in Alcoa. It was the same feature in Caterpillar, except in this case that the gap down was here and was selling off. So we ended up giving back this gain and ended up with a minus 0.5. It continued to sell off. There was a tradable move on the morning hook. I did not get that one though, but that's setting up more like an SSC again for Monday because the sell off in both cases is at about the same level. We don't have any indication of extra buying pressure except for the fact that they were willing to hold that over the weekend. So I think there's a good chance to, from a zero state here, see that thing get back to today's highs early in the move on Monday. So we'll be mindful of that. And then if that breaks, you really want to be long. I want to try to get two positions long on that one. But as it was, half an hour loss on Caterpillar. Cliff, let's see. Let me, just so we can see the, let me add a, I need to add. Need to put the daily. Yeah. Yeah. So this was Cliff's, and so we enjoyed that 1 day move. Got the PSAR flip yesterday. It closed pretty well. Then there was a gap up and sell off. So we were able to get out of that with like a little no lose plus dinner for two wedge, about 0.5. And then it closed poorly. So this is one where that's about the first time we've seen weakness in the metals lately. So that thing is looking to go lower on Monday. CVS, this was a long position that closed well. It sold off. We got about a 0.3 win, and then it continued to fail. So that's like a slow stop and reverse there at the edge of the dragon. And I played that strictly as an intraday. So that's about 1.5 and then flat over the night. That had real weakness though all day. And so I'll be looking for more short side on Monday. The Dow. So we had a COTA 2 yesterday that closed really well. Then it sold off harshly. So we kept about a 0.3. And then that was a stop and reverse because it violated the PSAR flip and then took it at the edge of the dragon. So that's about a 0.5 on a one risk. That's about 0.5. Devon Energy. This one we kept about We got about one out of that one. It closed well, but then sold off, so we preserved one. And this was just a bit of a hint of potential bounce in energy that late. That looks to me just like buying value on sale. Excuse me. So it had 3 days in here to fail further, but it really didn't. It basically had a pretty good, if grinding, 3 day move compared to the harsh sell off. So that looks to me like people positioning for front running on Monday up move, and we'll look for that. This was emerging market, yeah, electronic arts, excuse me. So this was a Kata 2 yesterday, and it closed well. It sold off, and we just took it as it was coming through the dragon, and that was about a 1-2 +3 on 1 unit of risk. And then it really went nowhere else. So I'm looking at that as a critical state, ready to break either direction on Monday. Emerging markets, we had two positions on. Uh, One was a SSC 2 days ago, and it moved out nicely yesterday, so we added a second position. It closed really well, and then today just started failing immediately, so we took it when it crossed through the dragon. Didn't wait for it to get to the PSAR, and so on the first position we got +2 and +1 on the second position, so that's about a +3, and then it just kind of narrowed into a nice tight critical state box, and that's ready to trade intraday in either direction out of that tight box, and then to get second positions if it breaks out of the daily range. So I'll be ready for that one. But this showed some significant buying interest after that large gap down because of the financial crisis. Mexico, again, this was a SSC, closed well, started selling, so we cut it, stopped and reversed at the PSAR, took the +1 intraday move, uh, watched it reverse, and preserved 1R. Brazil, basically just scratched. It had a beautiful run up, and we were holding 2R, and then in the first 30 minutes it collapsed, and we were lucky to get out of that with a scratch. It sold off and then just held. So the whole Latin America complex has got a nice tight risk box, compound critical state. The upside looks attractive to me because of that powerful move, but the downside has a significant way to go to get to the next support level. So that one looks to me well positioned for 3-minute bar trading on Monday. Intel. So we have been really riding this horse. We got a PSAR flip. Let me back out of that just a little bit so we can see it. Yeah, that was really like a Kata 2 and a PSAR flip. So we had Kata 2s galore, PSAR flip, kind of an emerging dragon almost. 2 days of really good movement, an explosive move up. We got the second position in. It closed very well yesterday. And then today, I think it gapped up and started selling off and caught it here at the PSAR flip. And on that really tight risk box, 4, 5, 6, 7, 8 on the first one, 3 on the second one, for a total of 11. Yesterday, we were holding 13. And then for a while, we were holding 17 because of the gap up on this one. So this is one that a lot of it got away because of the harsh overnight move. International paper. Oops, sorry. Pens get disconnected. So we played the SSC. It closed well, gap down. We took the scratch. It continued to collapse, and when it broke below the collapsing dragon, we took it for a 1 day intraday move of +1. Didn't get the second position or the reversal, but took pure intraday on that one. International paper. IYR. Let's see what we got here. So let's get IYR up. That's right. So IYR, we were flat on that one from yesterday's loss, and it just went sideways. And then today, during the sell-off at the open, it broke. So that was an easier one to believe in because it didn't have a long position that reversed. This was just a sideways that started selling. So we took that one with a standard unit of risk, picked up 2, holding it as late as we could. But I didn't want to hold that one over the weekend. So we took 2 at the edge of the dragon. Yesterday, I tried the SSC here on the banks, and it was looking really good at one point. At one point, had almost 4 in hand, then gave back 2 as it closed here, and then it sold off further, and was just happy to get out of that with a half. That became a stop and reverse. Same risk box, so we picked up 2 the other way, so total of 2.5. But if I were to do it again, I would have been more aggressive capturing that because it was started failing right where it was failing before. I'm just noticing, and I should not have been so quick to believe that regional banks were all as well when Europe still has to suffer through it. So bad play. Yesterday was the big gift in marijuana. We took that one for 3 and had no overnight position. It's still monkeying around. I didn't see a tradable play on the 30 minutes in that one, and span of control. Clean energy was a COTA 2 yesterday. So the COTA 2 closed well, sold off quickly. PSAR exit for a scratch, stopped and reversed. To play this again, I think I should have had the 1, 2, 3 exit down in here because it was clear I was needing to pick up some intraday positions. I think that was a better exit. I was hoping for more failure, and then I didn't want to hold it over the weekend, so we got out of that with +1. This is Rivian next. So Rivian has been on that long slide. We tried the reversal yesterday that closed well, but then it started crashing for a quick scratch. It still feels more like sideways action here, that the long slide feels like it's over. It's had one effort up that didn't hold, but it didn't fail any further. So it feels to me like 13 even is the fair value, and I'll be playing that as a neutral direction. This is the S&P, so we weren't trading it directly, but it held the double bottom. It made a new high, so I had reasons to believe that this was going to continue, but it crushed my hopes and dreams and gave like a 50% retracement from this gap. So it got right back into this around 390 and spent most of the day, couldn't really get off its own bottom. And so that's going to open up some more weakness for Monday. Treasuries, I just had to get a trade in on this one because I've been watching these swings and just haven't been able to pull the trigger. So on the gap up, I got a little piece in there just to get my hand back in, and that's about a 0.5. I didn't want to hold it any longer than that because I'm having a hard time pulling any swing patterns out of this. That's just intraday directionality, and a bird in the hand is worth two in the bush style, which is appropriate for a sideways market. Tesla, we had two positions on that one, an SSC and a COTA 2 that closed well. It started failing just like everything else. We took it at the PSAR stop, and made, I think, let's see, three on the first one and one on the second one for +4. And it closed pretty well in this kind of triangular looking shape. So I'm looking at this between 181 and 179 um, as the compound critical state, and I'll be ready for moves out of that $2 range starting first thing Monday. And then lastly, U.S. Steel, which of all the metals I think had the worst harsh sell-off. We tried the SSC, it closed well, it gapped up and started selling, so we took about a 0.5 on that one. So as you can see, we gave back a lot of the open gains that we had from yesterday's close. But you know, my positioning on that one, my reasoning gets back to where the S&P was, that we'd seen two moves off of this bottom, and the second move was stronger than the first move, like it broke through that resistance and closed very well. And it looked to me like, 400 was in play. And so I wanted to have positions long overnight, so if we got a gap and go, then I could take advantage of that move. But instead it harshed on me and sold. So some days you get the bear, some days he gets you. All righty, let's go to the sniper trade. Somebody asked me for the simplified trade framing. Here's all the questions that we ask on every single trade, on every time frame, and it's, what do you specifically see? Which way could it go? Which way is your bias? What are your entries? Where does it fail if it's going to fail? In other words, what is the signal that the hypothesis has failed, and then would you stop and reverse? And that forces you to be objective about the reward to risk on both sides of the trade. And then if you do have a trade that wins, and now you've decided that this is you want to be at worst no lose post dinner for two, this asks you questions about, where do you start preserving capital? Do you stop and reverse? How do you re-enter? And this is the rehearsal for the 2R battle drill. And then conceptually, for visual traders, this is how I look at it. The blue vertical is where I'm framing it. This was the last significant, compound critical state, if you will. That's the mechanical entry in both directions. And if that's a daily bar, then we can trade inside this yellow zone in here. If we can frame the intraday trade and then see 2 units of reward to 1 unit of risk, just on a test of the daily high. So you can trade inside the yellow zone if you can justify a 2-to-1 trade inside the previous day's range. So if yesterday's candle was large and it opens in here, and you're looking at that kind of from high to low, with a minimum manageable risk box, it's easy to find 2-to-1 reward to risk on a large candle. But if you had a doji, you can't really trade inside yesterday's range, but that's okay because of the range compression. You can get into the breakouts much easier. So the range compression of a doji gets you into mechanical entries in the green zone and the yellow zone quickly. Whereas if you have a large yellow zone, yesterday's range, then you may actually be able to trade inside the yellow zone. And then if it breaches yesterday's high, you have evidence that price is moving. Or if it breaches yesterday's low, you have evidence that the bears are now in charge. And then what I'm showing with this set of frames here is if I've got the daily high and low, I'm looking maybe for the 10-day high or some reasonable resistance level and maybe some reasonable support level. And I can start looking at key price levels or maybe Bollinger Band excursions or ATR multiples. And now I can start trading not only the intraday portion, but also look to see if this could convert to a swing trade as well. So this little template uh, makes me answer all of these questions visually, and that because I'm framing the trade in both directions, it helps me eliminate my directional bias or at least acknowledge it. It forces me to frame it in both directions, which means it's easier for me to follow the price because I realize that under ideal circumstances, I have trades that can go in either direction with favorable moves. And all the time I'm using a visual risk box so that wherever this thing starts to fade, I can quickly put that risk box on it and say, is there enough room for a move back to where it was? And that helps me with the stop and reverse decisions using a standard unit of risk, whether that's the the intraday minimum manageable risk box, or maybe if it's a swing trade, that's an ATR. This frame is independent of time frame. Like it's the same lens whether I'm using 1 minute chart, 3 minute, 5, 30, 2 hour, daily, 3 day, 9 day, whatever it may be. This same frame of reference is the fractal framing that we use to make sense out of the price action and the opportunities that are out there. Okay. Speaking of opportunities, this is a Ethereum on 9 day. So this is the whole life cycle of Ethereum, which used to be up around or ETHE. And you can see that this was in the joy where it got up to 45 and it's had 1, 2, 3 legs down. The legs are getting smaller. It based around 4 and now we're on the 9 day, right? So I'm noticing the PSAR flip here, and that winter has turned to spring and it's just breached to the upside. If we zoomed in on that, looking at the 2 hour, the 3, even the 3 day, anywhere in that shorter time frame, we'd have seen logical entries around 550 and 650, and it's up at 8.25 now, which is that's a 60% gain. It's not for the faint of heart, but it may very well be that the volatility of supposedly safe banks now strengthens the argument for, the primary argument for crypto. And Ethereum is well positioned in the crypto world in the number 2 slot to take advantage of that joy. So this is Trader X, and I always pay attention to 9 day PSAR flips after a long, harsh sell. So in the same way that this was instructive here, when it went from 43 to 35, that was an indicator. And the collapsing dragons were key. So just opportunities beginning to develop in crypto for the long term. Like you would have to say that it would take a price of $5 to tell you that this hypothesis that it's going to recover is over. That's the definitive price level. So if you're trading it at 8 and you're using a $3 stop, that's basically a 40% risk. So if I'm buying it at 8, let's say I'm risking $400 standard, and I'm risking $3 a share. That means I could have 133 shares of ETHE if I were buying it at 8. So that if it did hit 5 and I'm out. And, All right. Let's go to, let's see, Agnieszka. So she's doing she's trying the 30 minute now on the pound yen. And how nice is this? Nice Z3 pinch. That's her wrist box. Takes the breakout. Notice this is a super pinch. Tries to break out, gets a nice 0.6, re-entry for another R, 1.6. Nothing wrong with that. She got the sweet spot on the move. And if we're going to come over here and notice on the 30 minute, the belly of the dragon is a reasonable box. There's your PSAR flip, and that gives you 1, 2, reasonably available. The dragon is your friend. Now notice the width of the dragon during range expansion and how narrow that thing gets when you have range compression. So the width of the dragon gives some other information, which you can also see through the other Bollinger Bands too, but just interesting to me. I like to study the dragon. Here she is playing Ethereum versus the dollar, and she's got that trade that we just looked at. And she plays there's your range compression, the first breakout, and then the second one, that's like a Kata 2, second position, cashing it for 3.6. And this is on the 30 minute bar. Really nice work. All right, let's take a look at the reports. Sideways normal, everything in the low end of neutral. Risk Z is risk off, that surge of volatility you can see pointing down. But this is a place where you would expect it to base and begin a slow potential for upside. Risk or ETF2 is down to 10% because 9 out of the 10 indexes are below their 4-month moving average. The regression line fractal framework on the daily for S&P. So we've got a lazy Kata 2 forming here. So as long as this holds above the RL2, so like right now, you notice that the RL10 and the RL270 are in very close proximity. So that feels like fair value. But there was a time when RL10 was at maximum excursion away from the RL270. That's how much power the traders had to move it away from. This was something like fair value here. They both agreed somewhere in this region was the fair price. And the traders were able to push it that far away. And like a big fat magnet, it comes all the way back. So if this were to resume, then one of the things we can do is say the maximum excursion would be this size. So if it started from here, we could see that if they come in with the same power that they had here, not saying they will, but we wouldn't be surprised to see this get to 420 on the next surge. But if it fails to do that and starts collapsing here, then we would say that this same size excursion to the upside is now available to the downside. So if this collapses, we could now see a move down to, let's see, it's 370. That'd be about 360. If the sellers come in with the same downward pressure as the buyers did here, then 370 or 360 is our downside. You can see that power here. So we just bring that over and clone it, and breaks below the fair value. And that move would be essentially a collapsing dragon. So right now, that support level at the 270, which is right around 382, that's really important. And the fact that it was able to hold here averted a real disaster. Now we've had a little grinding upward movement, but it's already running out of patience because you can see the RL90 has rolled over, peaked, and is starting to decay. So there's going to be a test somewhere around in here next week that determines if this is going to go or if this is going to fail. And if it fails, look out for 360 below. Here's our 3-day, 9-day. Still a Kata 2 trying to develop, but it's tenuous. And the 9-day is holding that so tightly that it won't take much for this vulnerable price action to collapse. It's had, 3 months to make the move, and it hasn't. Hasn't failed, but boy. Greg asks a question: do we weigh the values of the different signals when in the trade process? Well, I would just go right to the trade frame, and you got to pick the ones that you like. Now, you see what I use on this one is the turning points in the RL10s and the PSAR flips. That's about as simplified decision making as I can get. So I look at the rising lows and highs or the descending highs and lows for directional biases and whatnot. But really, the breaching of the dragon or the breaching of the belly of the RL10s, those are significant to me. And you have what matters is it's like in the wood shop deciding which tool is best for which job you're trying to do. So it starts with your intention and what the opportunity is that you see. And to me, it always comes down to I want to start my decisions where the amount of uncertainty between bulls and bears has compressed to the maximum piece. That's what I mean by a compound critical state, is when range has compressed into the tightest little box, so it has a lack of volatility, and you can feel this coiled tension like a spring. And then if that trade location inside a look back period is at an extreme low or at an extreme high, it's those extreme positions, they're either going to break and it's going to be huge, or it's going to hold and it's going to rebound. So you get a combination of trade location and trade volatility to get a anticipation of what those um, trades could do. Like this little piece right in here on the 9-day, it had obviously harshed during COVID, made all the recovery, showed a little bit of resilience, and then consolidated in this tiny little box. And so that was a moment of extreme compound critical state, because if after that pause it's able to resume, it could be great. But if it fails, it's easy to see how fear would take over and could take you back to the belly of the RL10 and maybe to the maximum excursion. So this moment right here was one in which the trade framing process using these various indicators just alerts us to the potential for a very large possible reward in either direction for the smallest amount of risk taking. So that in general guides my view of the market, and it is a fractal framework in the same sense that I'm using the same patterns on 3 minutes and 30-minute bars and daily charts and 3 days and 9 days. there is a fractal relationship between those time periods. So I'm looking at common indicators and measures, and the only difference between those is two things. The first one is how much time there is between the next decision. So these decisions happen fast. These happen very slow. So I can look at a lot of charts over 9 days to frame them up while the next decision cycle is coming. But on 3 minutes, my span of control is going to be less. But then I'm making a lot of decisions intraday, and if I get a nice move, I can get paid. The only other thing that's different about these time frames is when we get to the daily bars, I have to contend with the gap. And you see that normally on the intraday, I'm looking at, like on the swing trades, I'm looking at 30 minutes. But then I have to contend with what is the gap going to do to me that makes this thing, I have to adjust my position size because that disruption between the 30-minute bars and the daily is different, right? Yeah, and Mike then asks, I think the Fed meeting is next week. Do I factor that in on the framing? Absolutely. That's because that's going to be a volatility event, and uh, the potential volatility in the Fed. How do I take that into account? Well, I'm still using the same Bollinger Bands and risk boxes. I just know that the move can happen fast. Now, on the very specific day of the Fed, what you'll normally see is that somewhere around 2 p.m., there's going to be a Fed decision. And so the market may have closed here, and then I'm never surprised to see a tactical morning move that goes to around noon, and then it kind of fades as the guys who made money here cash their positions and get flat, and then it gets into an extremely narrow range just before the Fed, and then you get large moves in either direction for about 30 minutes, and then one final move out of that before it closes. So if I'm trading on 3-day and 9-day, the Fed day itself doesn't mean anything because that little piece of volatility that you see in here is insignificant compared to the size of these 9-day bars. But if I'm trading intraday on 3-minute or 30-minute, that's a huge factor to take into account. And I got to decide how close to that volatility do I want to start trading? And do I want to hold a position through that volatility? Never. The swing trades already have stops that are appropriate for normal volatility. But I will tell you this, as you've seen me taking these swings that are 2 and 3 days, long, if I had on the 30-minute some like an SSC, and so I'm long here, and so now I get the Fed is going to be over in here. Here's where the Fed's going to be, and maybe I got this. Maybe I'm able to get this kind of move, and around noon of that Fed day, I'm holding on to this position. And if my risk gave me a 3, I'm holding +3, and the Fed's going to announce in an hour. Why do I want to subject that 3R to the noise of the Fed, which could erase that in a minute? So I might use that in that case. Depending on what trade I'm evaluating and I'm looking at the risk, I might make an intraday decision to exit this, and then when the Fed is over, I might look to re-enter it once the Fed is over, because maybe the thing is starting to work again. I don't know. So you need to know inside the little trade frame of your time, what are the significant events that are in there that can add volatility in the short term, and then account for that. And a lot of that is just evaluating how much open risk that you have. Generally speaking, I would say when you're first learning to do the intraday trading, you should trade the Fed day with one share with technique, so that you desensitize and don't make it scarier than it is. It's not scary, except that it's scary. but it's nothing to be fearful of. You just got to put on your fireproof underpants and get in there and start engaging with one share. So there's a lot of tools in the workshop, and we want to start by carving a wooden bowl with a penknife. Start with the simplest tools in short periods of time and get repetitions and get comfortable with one tool to make one bowl and to be intentional and controlled and able to build muscle memory. Keep it simple and contained inside a simple, like there's 30 different workstations in the wood shop. Don't try to use them all at the same time on one complex project while you're learning the tools. Go to one station, work on one thing, make one bowl, and then start adding things to your repertoire. Take a look at the different styles that we're using here. That's how you should be using the coaching techniques of the folks who are posting their trades. You can see what they're doing. And as you watch these every day, you'll start seeing people that have different styles, different symbols, trading in particular ways that suit them. And they are finding their niche for the kind of bowl that they're trying to make. So don't try to catch them all. This isn't Pokemon. Okay, back to our regular, hopefully that helped. The market 150. We've got these two recent highs and lows. This was just outside the 30. So now you can see the 30-day range, and we've got price right here in the middle of the 5-day range, in the lower half of the 10-day range, in the bottom quarter of the 30-day range. So this weakness in here is putting price at a certain risk. And the triggers on that is, here's where price closed. This red bar shows you the daily low. That's a trigger. So if Monday price comes out of that yellow zone, that means that there's more bearish pressure than there was today because they're pushing it to a new low. And then the next trigger is the belly of this RL10. So if that fails, now we have a collapsing dragon, and you would expect a harsh move to the next absolutely critical level, which is whatever it was, 380. That is a combination of a 5-day low, 10-day low, and 30-day low, and and right at the dragon belly. And then the next one is the belly of the RL10. So this is a huge 380 is hugely important. So that's a tripwire. So I can already put a sell order for the market in here and in here. Because if that just trips through here, I don't even want to think about it. I want to be so short, so fast, because if this support level fails, then it's coming all the way down to here, to 364. Like I said before, 364 and 360 are in play. So now I know that on the daily charts, I've got 1, 2, 3, 4, 5 little tripwires of increasing danger as we go. And the more it goes down, the more short I want to be. So I'm framing that to the bottom side, and I have very specific trigger points that tell me what my action is. So I don't need a whole lot of planning. I need just that much planning. What I need is preparation in order to rehearse. Boy, is that a horrible looking diamond? Sorry. I need better decisions. That's supposed to be a diamond for a decision point. Long or short or stand aside. So I need just enough information to trigger me to make good decisions that are risk adjusted, favorable reward to risk with very precise trade frames. And I want to try to get a number of those for different scenarios or different contingencies or different targets. So instead of trying to have the maximum plan, I want to be well prepared for some carefully rehearsed decisions that are favorable to me. And all of my decisions start with targets that are in compound critical states, as I just got done describing. So I want to plan less, but make better prepared decisions. I want to be prepared to make better decisions based on execution and price action. Not trying to confirm my plan. I just want to follow price. My plan is to follow price. All right, the 30-day look back. Now it's even easier to see. There's that the breakdown below today's low, the breakdown below the belly of the RL10, the breakdown here of the 5-day, the 10-day low. That was this price, and the 30-day. That price right there, which was the sell-off during the Monday of the regional banks, was scary. The market has rebounded to here. It stayed pretty much in this channel to the upside, to the downside, and then closed right here. But it doesn't take much for this to start collapsing further. Because if it gets through 380, again, look out below. The 30-minute caught at 2 is in play for the S&P. But again, it's vulnerable right here. Now, what that means is I've got a very small risk box. So if it actually starts going up in here, I can get a reasonable trade to the high of the day, and then if it breaks out above here, all is forgiven. So the upside intraday trade's available, and then the stronger trade to the downside is available. And if all those break, look out below. No, hey Bill, I'm going to Pittsburgh to work. Let's see now.
Sorry, I didn't mean to.
Yeah, I'm just telling you. That's all. No worries.
Gotcha.
So blended monthly rebalancing. Tech actually was leading the way. That was the only saving grace this whole week. If it's not for tech, this whole market looks pretty bad, whether it was S&P Tech or NASDAQ. Otherwise, it's pretty horrible. Energy has had such a beating that maybe this is now at the bottom and ready to start rolling back up. So I'm ready for that sector to respond to that horrible sell-off. Gold had a nice week. Silver had a very good week. Finance and oil and clean energy gets smashed. That's that PBW short we've been playing. Microsoft getting ready to join the dividend achievers. I've been riding that pony. And Apple not bad, but pales in comparison to its running buddy Microsoft. And there's our Intel. Now, if you've been following along with the daily swing patterns, you know how we found ourselves into Intel. And that's one of the ways you answer the question, how do you find the movers? Watch how we find them on the 30-minute charts and the daily swings. And by comparing them against the other candidates in that small batch of carefully selected swing trades and tactical trading set. I'm just, I narrow my focus to about 50 symbols, ETFs and large cap companies in a variety of sectors, so that I can see, hey, maybe this sector is the one that's working, or maybe now it's this one's going down and this one's going up, so I can play the exceptional moves and be locked in on targets that are more prone to move a lot. Like I'm going to be going to look at these guys here. They got murdered so bad. Is Caterpillar really that bad of a company? I don't think so. Disney, now notice it's down 15% for a month, but was basically flat for the week. So over the last month, it did this, and then this last week, it did sideways. So why didn't it fail further? Well, maybe buyers are coming in to get it on sale. Does that mean it could rebound next week? Yeah, it could. So it may be, if I can see a small risk box and a reasonable multiple to the upside and get a 3-to-1, now Disney is going to be in play. That's how complicated your planning might need to be, I would, in the world of finance, JP Morgan, although that looks bad, that's nothing compared to Goldman Sachs, which is getting slaughtered. So in the battle of the large cap banks, JP Morgan is a clear winner, and they're buying up all of the goodies from all the regional banks that are failing. They're getting assets on sale, so I would expect their advantage over Goldman Sachs to continue. ETF Max, notice all of the defensive plays and semiconductors. Semiconductors, Intel, Texas Instruments, and NVIDIA are sufficient for us. 2 weeks ago, 8 of the 10 indexes were above their 4-month moving average. Now only one is, and U.S. tech is the only thing keeping the world afloat right now. That's the NASDAQ compared to the rest of the U.S. That's how strong tech has been. ETF liquidity, we're looking at the ATR percentage of the top ETFs by average daily dollar volume. Green are the ones that are both liquid and very volatile. I mean, look at regional banks. 7% intraday normal range from high of the day to the low of the day, and large volume. Energy, gold miners, oil exploration. That's where the juice is. Daily report for Monday. So yeah, we've already seen most of this. Sideways, broad weakness, risk off, volatility right on the edge. ExxonMobil, Nucor, Caterpillar, Chevron. So metals and energy all down. The large cap targets, plenty of auto framers, 5DDs and IBM, 3M and Pfizer, Microsoft and NVIDIA, big breakouts. Gold, one of the few joyful signals. Clean energy suffering. Uh, we're so far from the 10-day high that there's a ton of auto framers available. Go to the lots of Godzillas to consider, plenty of double greens. So those are the enraged Godzillas, and then a handful of double quiet Godzillas. All of those are available. Oil, Raging Godzilla, Lithium, and Rivian, quiet Godzillas. We got that Rivian trade working already. Inside the auto framer, the metals are still, 5 and 6 to 1. U.S. steel not quite as bad. The semiconductors all looking pretty good. Like they're fully valued. Not great for swing trading because they're already so far along, but that's just a measure of how strong they are, with Intel being the strongest. And everything north of this blue line is better than 2 to 1 on the reward to risk ratio. So there's some opportunities in there for buying pressure. All right. I think that's everything I want to cover. Otherwise, just standard stuff. All right, that's everything I got for tonight. We'll see the swing traders tomorrow, and we'll be prepared for Monday. Take care.